Welcome everyone to Vested Interest. This is Shane, and in this video I wanted to start off by asking a question. Do you want to be wealthy? I mean, that's a dumb question, I know, but do you really want to be wealthy? Well, in this book, some of the things that they cover are some basic guidelines to follow for those who want to be wealthy. And if you take these guidelines and then take the steps to actually put in practice the guidelines laid out, in my opinion, I believe that they will give you the basis to provide wealth for you and for your family in the future. But really, guys, it's up to you what you do with the information. Obviously, you're here looking for information. So I'm going to cover what I think were some of the best topics from the book in regards to wealth creation. And again, if you'll follow these basic guidelines and then take some steps on your own to put into action, I think that you would over time become wealthy. Now, if you're looking for a quick fix, make millions tomorrow or make millions this year, this isn't that type of channel. I don't think this is that kind of approach. You're better off just going and buying a lotto ticket if that's what you're looking for. Now, with that said, let's get into the book. If you haven't read it, I would suggest it. It's a pretty easy read, relatively short, but it's full of a lot of stories with quite a few lessons packed within it. I think that are really good lessons to live by, again, for anyone who wants to be financially successful and create wealth not only for themselves, but generational wealth that you can pass on from yourself to your heirs. So with that, let's get started. And the first topic in the book I wanted to go over is what they call the 7 cures for a lean purse. And the first cure, start thy purse to fattening. Now, what are they trying to say here? Basically, one of the things they get to in the book is to pay yourself first. Put away a minimum of 10% of everything that you earn. So out of every $10 you earn, you're going to put away $1 for yourself, whether that's in a high yield savings account, whether that's in investments account, whatever that is in, out of every dollar that you make, a minimum, and that's a minimum, should be 10% of what you make should be going away for yourself. Second, the second cure for a lean purse, control thy expenditures. Basically what they're saying here, guys, you need to distinguish between your needs and your wants and set a budget based on your needs. I mean, we've all got wants. I want a lot of things that I can't necessarily afford, or I could afford them if I went into deeper debt. But it's really, do I want to go into debt, or do I want to take that money that I would utilize for the wants and put them to work for me in the form of investments in real estate or stocks, or like I said, whatever it is your chosen investments are. And the third cure for a lean purse, make thy gold multiply. So this gets into the investment portion, guys. Invest in assets that produce cash flow. So it's taking the money you've already made from your day job, or maybe you inherited some money, whatever it is, and then putting it to work for yourself. I prefer dividend growth stocks because it's pretty passive. Once I buy the shares, or once I do the research in the company, decide I want to invest, buy the shares, those shares return to me in dividends every month or every quarter, depending on what it is, some yearly or semi-annually. What you invest in is up to you. My investing style, utilizing dividend growth stocks, actually will fulfill all of the 7 cures for a lean purse. And you could also look at real estate and rental properties. That would also be a passive way to produce income, especially if you utilize a agency that oversees the properties for you. And then once the land is paid out, right, you'll have additional cash flow. Your renter will pay the loan back off. Maybe you get a couple $100s off while the renter's in there, but then once the mortgage is paid, you'd get additional income as well, plus the appreciation from the home value. So real estate is another good one. Let's get on to the fourth cure for a lean purse. Guard thy treasure from loss. Now this comes down to protecting the capital by de-risking whenever possible. There's also other ways you can protect the capital that you already have, or money you've already made, properties you already have, insurance. We all, if you're a homeowner, have homeowners insurance. If you're a renter, you should have rental insurance to protect the assets that you've already purchased. Jewelry, guns, all those things, depending on how much of them you have, you may want to have additional insurance. I know my wife has a significant amount of jewelry. I have a significant amount of guns and precious metals that I've invested in over years, so we've increased our insurance. And then also being diversified, making sure that all your eggs aren't in one basket is also a way to protect what you've already earned. Now the fifth cure, make of thy dwelling a profitable investment. This comes down to owning where you live, really. Own your own home, don't rent. Whenever you rent, you're paying someone else's mortgage. Your home is an asset. You can leverage your home to buy more assets. So let's say you have a significant amount of equity. You've been in your home for 10 years, 20 years, and you've built up a significant amount of equity. You could then go to your bank and take out a cash out refinance or a HELOC loan. I know we're looking at a HELOC loan to put in a pool right now, but instead of putting in a pool, you could take those funds and buy additional real estate to rent out, put money in the stock market. Some people will leverage their account. There's ways you can leverage your stock market account and utilize additional funds for investing as well. And again, once that loan's repaid, you can increase your earnings. And one way to do it, rates are relatively cheap right now. If you could get a cash out refinance, for example, around 2.5 or 2.6, 2.7%, and you're able to get someone in there for a 5% return, well, you've just increased yourself by 2.5%, right? You'll have some profit there. So as an example, again, if your loan is for 3% interest, you would need to make 5% interest on the loan, and then you'd have a 2% return as the loan is being paid. And then once the loan is paid off, you'd have the full amount, whatever that rental would be. The sixth cure, ensure a future income. So again, for you and your family, not just for you, we all need to think about what happens when we can no longer physically work or do what we are currently doing. I also think about what I'm going to leave my children. Again, my dividend growth portfolio will pay me once I can no longer work, and if I've set it up correctly, it'll continue to grow as the dividends increase from the companies that I've invested in. It'll not only provide future income for myself, but I am working to set it up in a trust so that it will provide additional income for my family and my heirs, hopefully their children, my children, their children's children, all the way down on the line. If I set it up right, I'm going to set it up to where they can't draw out more than 30% of the portfolio, and really I'm thinking about just setting it up where they can't draw out any of the income that's originally invested. They could only draw out the dividends that are paid out, and maybe even just a portion of those. So if the portfolio, for example, is producing $100,000 in dividends, maybe they can only draw out $60,000 a year, and the other $40,000 goes back into reinvestments, additional investments in real estate or additional stocks in the portfolio itself, whatever those investments look like, but it cannot just be taken out to be spent. And then last, the seventh cure, increase thy ability to earn. The best way to increase your ability to earn, in my opinion, is to be of more value. And what I mean by that is to have a skill or multiple skills, or learn a new skill or trade, even a hobby that could produce income. The more opportunities to provide value and potentially earn more based on the amount of information that you know. For example, at your job, you can learn more if you're not good at Excel or PowerPoint or some other software that you utilize at work. Or you could learn a new Excel or PowerPoint or software program. If you're in construction, like a rough carpenter or something, you could earn more by learning to be a finished carpenter. If you're in construction, you could also learn how to bid work. I've been in construction for a long time. I know whenever I learned how to bid work, I was able to do side jobs on the weekends and make a little bit of additional income. There's a lot of different ways to increase your ability to earn. I started this channel as one of the ways I'm trying to increase my income. Another thing I've done recently, if you look down below, if you're interested in signing up for Webull and starting a financial investing portfolio, drop some money in a Webull account. You can use my link down below. We'll both get some free stocks, so check that out if you're interested. I do some investing in Webull in more of I guess higher risk, non-dividend paying stocks that I don't really cover on this channel. But if that's something that you're interested in, or you can buy dividend paying stocks as well. You don't have to just pay non-dividend paying stocks there, whatever you want to invest in. I think they do some crypto and some other things there as well. So those are the 7 cures for a lean purse. Men of action are favored by the goddess of luck. That's one of the things from the book. So take action. You got to take the first step. Don't procrastinate. That is one of the lessons in the book as well. Ask yourself, how many opportunities have you missed by not taking them? By procrastinating and saying, I'll start tomorrow, next paycheck, when I get a bonus, when tax return arrive next year, when I get a raise, etc. There's always a reason or an excuse not to start. Another topic in the book, similar to the 7 cures for a lean purse, I'd like to cover before we wrap up. Very similar to the 7 cures for a lean purse are the 5 laws of gold. Gold cometh gladly, increasing quantity to any man who will put not less than 1/10 of his earnings to create an estate for his future and that of his family. So we're back to that. Put away at least 1/10, 10% of what you make. So $1 out of every $10 that you earn should be going back to yourself, either in savings or, like I said, in some sort of investment to create additional income. The second law of gold, gold laboreth diligently and contently for the wise owner who finds for it profitable employment, multiplying even as the flocks of the field. Now, Einstein called compound interest the 8th wonder of the world. And that's really what they're talking about here, guys. Compound interest. That's another reason why I enjoy dividend growth stocks. They pay me dividends, which I drip dividend reinvestment plan, which buys directly back into the stock that paid out the dividends. So I'm constantly increasing my shares. I'm also adding to them by buying new shares whenever I get paid. We'll get a bonus, get taxes back. I typically don't get taxes back. We typically pay into taxes, but that is just the nature of higher earnings. The third law of gold, gold clingeth to the protection of the cautious owner who invests it under the advice of men wise in its handling. I'm not the wisest person as far as stocks go, so I'm constantly doing research. I'm constantly asking for people's advice, looking up as much information as I can. I look at 13 F's from Berkshire Hathaway, for example, give me an idea of what Warren Buffett is investing in. Ray Dalio, I like to read books by Ray Dalio and look at his 13 F's as well to see what he's investing in. Those are 2 of the people that I really like as far as investors, and I try to mimic what they're doing, which again led me to dividend growth stocks, and that's part of the reason that I chose those. These are multi-billionaires, and these are the steps and ways that they've invested in. And if they did it, then I think maybe that's a good way to do it. What you do, again, there's a lot of people out there who like real estate. I've made a significant amount of money in real estate myself. I'm in my 3rd house now. I bought my first house in 2002 out in Utah. I lived there for 5 years, made about $50,000 on that. And then my wife and I in 2009 actually 2010, I think it was, bought a house in Detroit. Everyone said we were crazy because it was obviously at the bottom or right close to the bottom of the mortgage crisis. And plus it was in Detroit, and we made, a few $100,000 on that place. So there are more ways than just dividend growth stocks, but I like the passive nature of the dividend growth stocks that I'm in now. and I am going to be looking at real estate in the future. That this portfolio will actually be used as a way to leverage to take loans out against real estate purchases in the future. That's part of the plan for this portfolio. Number 4, gold slippeth away from the man who invests it in businesses or purposes with which he is not familiar or which are not approved by those skilled in its keep. You're seeing some of that now, guys. A lot of gurus out there on YouTube and pushing courses, high multiple stocks that were climbing high for the last several years for no real reason, no earnings. Companies are what I would call zombie companies, only alive based on huge amounts of debt and their cult-like following, pumping more money, buying their stock, running it up. Just absolutely insane, in my opinion, some of the valuations on these companies that make absolutely no profit. And you will see now, as these stocks are losing 20, 30, 40, 50%, that these individuals will be losing 10, 20, 30, 40, 50%. And really, these stocks could stay down for a long time. I mean, I'm old enough to remember the dot-com crash, and a lot of the companies that were, going to be the next great dot-com whatever are no longer even in business, guys. So that's where we're at now. As things slow down, you'll see some of these pie-in-the-sky fantasy future earnings will be crushed because interest rates will go up, and the earnings based on 0% interest that they thought was going to go on forever just are not going to be that way. And the 5th law of gold: gold flees the man who would force it to impossible earnings or who trusts it in his own experience and romantic desires in investment. This is, again, much like the last one. We've had a lot of unrealistic expectations for gains. I get it. The stock market's been up 30, 40% at times. People have made millions on this, and I think that's great. If you were smart enough to jump into some stuff in crypto, for example, and make some significant profit, I hope you pulled it out before some of these big crashes and did something that actually was based in, realistic returns, was based on realistic earnings, companies that make a profit, companies, real estate that actually has value. I'm not saying I haven't invested in some crypto. I did buy some Shiba Inu earlier this year when it was very, very cheap. And then as soon as it ran up, I sold it and I rolled those profits into my dividend growth account, because hype goes so far, and then you have to look at what it is, the real value. Is there real value? And right now we're in, like I said, even today, some unrealistic expectations of returns. Once you've earned a significant amount of money, save, don't be frivolous or invest foolishly, like we've talked about, unrealistic gains and unrealistic time frames. There are occasions people get lucky for short periods of time, but over long periods of time, that's rarely the case. Better a little caution than a great regret. Now, one of the last things I want to touch on that people may, in the book, touched on a little bit about procrastination, so I want to touch on it here as well. Someone might ask, well, what if I have debt? Don't let debt be an excuse to procrastinate. You can invest while you have debt. So I'm going to touch on that for a minute. You can start by setting a budget, like you saw on one of the items above. And one of the things in the book it talks about, I know the 10% rule, but a way to do it if you have a budget is to use the 70-20-10 rule. So 70% to all living expenses, including entertainment, 20% to repay your debts, and 10% to savings and investments. Well, that's actually pretty similar to my breakdown, except for the 20% in debts. I don't really have any debt. I went back to work in 2019. I had taken a few years off to help with my kids. I've got 2 girls. They're 7 and 9 now, but they were both in, one was just starting school and one was still in daycare. My wife got a raise at her job, made executive. She works for General Motors. And then I did that for a few years. And then when I went back to work, we had basically set up our bills based off of her income. So we were able to, the first year, we focused a little over the first year, about 16 months. We focused on paying everything except for our house off. So we had a little bit on the credit cards. We had a little bit on a couple jet skis we had bought, and then I had my truck that we had bought 4 or 5 years ago. So we were close to paying that one off anyway. We had about a year left on that loan, but we really focused on putting a little bit extra towards the credit card first because that was the highest interest rate, then to the jet skis, and then the truck we didn't really add any additional to because it was 0% interest whenever we bought it. So now we do a 70% pay of our income, hers and mine, pays for all of our living expenses, and then I put about 29% into our portfolio. That's the reason I put such a significant amount every other week or every week sometimes. And I will be putting a significant amount here in March whenever we get our bonuses, because again, we don't have any debt right now except for our house. We are, like I said, I mentioned, we are doing a HELOC loan. We're going to put a pool in the back, but that'll come out of our 70%. And then the other thing, once you pay off that debt, you can increase that 20% that you were repaying your debts. You can plug that into your investments, right? So I do about a 70-29-1. If you don't have a emergency fund, start by increasing emergency fund 3 months, at least 3 months of living expenses in an emergency fund. I recommend 6 months, but that's really up to you. If you have 3 months, you should be okay. But focus on paying off that debt. There is a way to do it while you're investing. 70% to all living expenses, 20% repays your debts, and 10% to investments or savings. And like I said, if you don't have a fallback account, an emergency account, set that up first, and then as your savings, and then set up your investment account with that 10%. But you can do it while you have debt. So that's it, folks, for this video. That's a quick overview. Hope you enjoyed it. Be sure to hit that notification bell and subscribe to the channel if you haven't done so already. So in my next video, what we're going to be doing is wrapping up the 11 market sectors series that we started here before the end of the year. We've got one more video there before we wrap that up. So subscribe to the channel and hit that notification bell so you don't miss that or any future videos that we have. And don't forget to show me a little bit of love. Hit that thumbs up or thumbs down if you didn't like this video. Let me know what you think about the book. Have you read the book? Have you read the book, or do you have any suggestions for other books I should read? Let me know that as well. I do personally read and respond to the comments and would love to read your opinions and any questions or suggestions as well. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, we'll see you in the next one, guys. Just a reminder, I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you are not comfortable losing. Always do your own research and invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor. Guys, this is Shane. We reviewed The Richest Man in Babylon. If you haven't read it, definitely suggest you taking a look at it. Have a good one. See you in the next one.